Hey everyone, my name's Wilson Myhre. I'm the Director of Business Expansion at the Knoxville Chamber. Local business investments play a vital role in driving our region's growth. Our community is home to numerous organizations that offer essential resources for those starting, transitioning, or expanding their businesses. Equally important are the resources available to guide established businesses in planning their next steps, including succession planning. Today, we are joined by community partners who are experts in this field. Doug Kose, President of Transworld Business Advisors of Knoxville and Chattanooga. Donnie Iverson and Todd Kelly, financial advisors from Merrill Lynch. And recent succession planner, Cynthia Jeffries. Before we get started, I want to thank our regional enhancement partner, Cirrus Aircraft, and our economic development ecosystem partners, the Chrisman Company, Fifth Third Bank, Mesa Associates, and McCarty Ozapple McCarty for making today's program possible. Everyone, please welcome Doug Kose, President of Transworld Business Advisors of Knoxville and Chattanooga, Cynthia Jeffries, founder of Jeffries Woodworks, Donnie Iverson, financial advisor at Merrill Lynch, and Todd Kelly, also financial advisor at Merrill Lynch. As we get started, please remember to use the Q&A function to submit any questions you may have. Our panelists will address them during the Q&A session at the end. So let's start our discussion. And the first question I'm going to direct towards Doug. What are the exit options for a business owner, Doug?
All right. Thank you, Wilson. Well, let me first say I'm fired up to be here. Very passionate about this subject. We've got a great panel. So I'm glad you all are here with us today. So I really see there's 4 scenarios for a business owner when they're thinking about exiting their business. First one, we call it milking the cash, which means a true asset sale. So that's a liquidation process where you're going to liquidate your inventory, your equipment, your vehicles, and you're just going to close the business down. Second option would be a family transition, and you continue to run the business by passing on the business to family members. Third option would be a management buyout with key employees, also called an ESOP, which is employee stock ownership plan. And then the fourth option is when you know your business has value, maybe you don't have key employees to pass it to or family members, you go to market and you sell to a third party. You'd get a business valuation. You take the business to market, you'd find a buyer, usually do that in a confidential manner, and you sell to an individual or an entity for an agreeable price. So those are really the 4 options you have as a business owner.
Thanks, Doug. Next question to Donnie and Todd. What are the first steps a business owner should take when considering stepping away from their business?
Yeah, well, Donnie and I are with the Kegel Cross Group of Merrill Lynch, where we manage a little north of $1 billion, and a lot of those dollars come from business owners. We have several clients that have sold their businesses in the 8 and 9 figure area, but they mainly rely on us to help them navigate their general cash flow from their liquidation. As Doug mentioned, there's multiple ways to do it, which comes with different tax implications and other hurdles that come along with the sale. When it comes to both mergers and acquisitions, the earlier we can plan with our clients, the better the process typically goes, not just for the seller, but also the buyer.
Yeah, and I would say too that early in that process, as someone is considering selling the business, 2 things that really should be considered. Number one is what kind of cash flow do you need to generate to replace what you've been cash flowing and owning your business? I know that all the business owners that I talk with, cash flow is of the utmost importance when you're managing a business. And so replacing that cash flow with assets that can generate cash flow is very important. That's one of the first conversations we have with anyone is how are we going to replace your cash flow and keep you earning enough to pay your bills? But secondarily, early on in the process, it's important to put some steps in place that can help you to save money on taxes, because selling a business is going to be a major taxable event. Big long-term capital gains, maybe even some depreciation recapture, some things like that. And so planning for that, there are things that you can do in your investment portfolio. There are things you can do with titling your business. If you're charitably inclined, there are a lot of complications there. And so talking to someone early on, whether it be a tax advisor, financial advisor, about having things set up properly, even years in advance of that liquidity event, can really set you on a good path.
Okay, so I'm going to go a little bit off script here, guys. So I heard early on in the process. Can you put a little clarity around what early on in the process might mean to business owners?
If you own a business, it's now. So I think that that those are things that it's never too early to start. Considering, and you know, that cash flow component, that's going to be later in the process, but early on, thinking through titling and thinking through saving money on taxes in the long run and how things are structured, it's never too early to start that conversation.
Yeah, and I'll jump in, Wilson, just to say that when we talk to buyers and lenders, they're going to want to look at the last 3 to 5 years of your tax returns, current year P&L, balance sheet. You know, I've got some clients that say, hey, well, 10 years ago, we were at our peak. Well, that's great, but it's really what you've been doing now in the past few years. That's when you really need to think about, if I'm going to sell my business, look ahead that amount of time. Unfortunately, a lot of people do come to us, say, I'm ready to go right now. I want to retire right now. And it is what it is. But if you're thinking ahead, that's the timeline I would be looking at.
So I see Cynthia shaking her head. So I'm thinking she's got something to say about this. So Cynthia, what motivated you and your family to pursue a succession plan for your business?
Well, thanks everybody for being here, and thanks for allowing me to share my story or a little bit of it with you. It was simply the calendar. My husband turned 65 and our customers started looking at us and going, what are you guys going to do? You know, how much longer are you going to be able to do this? Because at that point we were heading toward, I don't know, 34, 35. I don't know. We'd been in business for about 30 years at that time. And it was evident. It was evident to our client base. It was evident to Bob, my husband, and to me, to some degree also, that it was time to make a plan. And we had already had the ability to level up on our accounting and our systems and start preparing our books. As Doug said, people want to see the books. That's the first thing they want. And so we had already cleaned everything up. And for all you business owners out there, when you do make the decision, you better make sure that your books are audit ready, because everybody's going to go over you with a fine-tooth comb, and you cannot be too ready, and you cannot have enough good years of records to show. I mean, like Doug said, you know, 3 is standard, 5 is a lot of people are going to do that big ask, and we started even well before 5 years.
So, and again, you know, I'm going to go a little bit off script here, Cynthia. So, I mean, you had a milestone coming with related to age, and Bob
Yes.
turned 65.
Yes.
What would you say to younger business owners who have not been in business 30 years? I mean, what type of advice would you give them?
Still upgrade to get the best CPA you can get. Use the IRS recommended software. Make sure your systems are as clean as possible and your books are as clean as possible. And it took us about 7 years, really, to get ready to walk out the door. And it really, and we talked to a lot of people. We networked. I'll speak in depth to that later, but it takes 7 years. So if you're wanting to do it now, look at your age and add 7.
Okay. Thank you, Cynthia. So next question for Donnie, Todd, and Cynthia. How can a business owner start a conversation about succession planning with stakeholders and family members? Donnie and Todd, start with you.
I think that's a challenging one because the dynamics are always different. You have some family-owned businesses where family members feel like they are entitled to step in and run that business, and so I think you just have to be very frank in those conversations, especially with family members. And we've seen that a lot. You know, and you see this succession of businesses, successful businesses, where the person who pioneered the business is the entrepreneur. Second generation typically just tries to hold on to it. And then third generation, things can go a lot of different directions. And I think it's just really important to have very frank conversations with all family members in those types of structures. When it comes to stakeholders and shareholders, it's a little bit different, because stakeholders and shareholders, it may not have as much emotional tie as it is just a monetary tie. And so I think that of the utmost importance is just making sure everyone is on the same page and understands expectations, and is really everyone's rowing in the same direction.
Yeah, I'll add on to that very briefly. Advice. You know, get advice from specifically, you know, the younger business owners. We're blessed today to have a very young panel, all in each of us. But for the young business owners, you know, just to realize that you have people that have done it before you. And as Cynthia prefaced, 7 years, sometimes that's not even enough, right? So to really take into consideration that you're putting the majority of your capital into your business, and one or two wrong decisions, whether it's, you know, tax or, you know, choosing the wrong CPA, could, you know, end up harming you in the end. But getting advice, right? If a GPS tells you to turn left, turn left. And it sounds so simple, but I think a lot of business owners get so caught up in the day-to-day that they don't realize that people have gone through the process before. So that's what's great is, you know, our clients being able to, you know, come in and help our other clients that are in the process, and just lead them from point A to point B all the way through the process, which takes time and diligence. But at the end, they're so grateful that they were willing to speak up and ask questions.
Cynthia?
Well, just addressing what he finished with, if you are going to ask for advice, be wise enough to take that advice. And that's often not easy, because sometimes we're hoping to hear something different when we ask for advice, but the truth will take you where you need to go. And for us, we actually ate up a year dealing with family and their decision, and I don't regret it at all, because all of us have clean hearts now. We asked our son, who had actually been with us from the very beginning as a 10-year-old. Of course, he was out in the business world at this point. He had graduated from UT and was working in his chosen field. And so we asked him if he wanted the company. And actually, my daughter-in-law, his wife, wanted it more than he did. But we gave him a year. We gave him a year because they deserved it. And it was that important to us. And so we did not pressure them. We knew what our goals were anyway, as I had spoken to earlier. We were busy increasing our profit so that our business would be bigger, more stable, that we'd have those 5 or 3 years of excellent books. So we weren't at that point in a rush. So we did go to them first. And I think that it behooves you to make sure that that is completely settled, that all those issues are behind you if you do go public with it, which is the next thing that we did. And consequently, we our little grandsons who loved our company are still a bit heartbroken, but they were far too young. We couldn't hold on until they came of age to run it. So it was almost one of those generational skipping things. You know, had they been 10 years older, or I had been 10 years younger, that might have worked, but not our case.
So to kind of piggyback on that, it sounds like that was one of the significant challenges you faced during the succession process. So what are some of the other challenges that you faced, and how did you overcome them? And I'll direct that back to you, Cynthia, and then ask Doug to come in as well.
Well, we sought the advice of so many people, and we listened well, and we tried to heed all of that advice. And aside from, of course, having the excellent clean books and growing the company to the point where it would support not only a salary for a new owner, but the debt service that would be required as well. That was our biggest goal. And so, Doug can speak to this. We never took our foot off the gas. We just grew and steadily increased year after year. And that was our stated goal. We wanted to go out on top. Whenever going out was going to happen, we wanted that year to be our best year ever. And so we never let up, not once, not 1 year. Every year, year after year, year over year, our growth and our profit was higher and higher.
Yeah, and just to add on to that, I do tell my clients it's going to be an emotional roller coaster. You're going to meet a buyer, you're going to feel really good about them, but maybe the lender doesn't approve them for a loan. Maybe the landlord sees it as an opportunity to increase the rate significantly and eats into the cash flow, and the buyer says, yeah, I'm out. So this might be a bad comparison, but it's kind of like dating, right? You're going to date all these people in the process, figure out who you like, they like you, get an offer. Now we're engaged and we're trying to get married, which is the end, the closing date. And it's going to be a series of ups and downs. And, when you're selling your business on the market, it can be a long process. It's not like selling real estate where it's 30 to 60 days and you've got an offer and you close. And we'll talk about the process, how long it takes, but it can take a while. So just to be prepared that you're going to have a lot of ups and downs going through it.
I have just one last thing to add to finish up on what Doug said, if I may. My husband and I were counting, and we can together recall over 15 potential buyers that approached us or were interested in us to the point that we shared our financials with them. 15 buyers. So it is very much like being on the dating circuit. I mean, you just have to grin and bear it. People are going to check you out up and down, and you're going to have a lot of different people come knocking. And I am so grateful that none of those blind dates worked out, and that the people who have our company now have it because they were the right ones. And I'm so glad that none of those other deals came together. So don't lose hope, and when I'm telling you, we worked with 15 different buyers. It was, and finally, about that, we learned so much from every single one of those experiences. Every conversation we had, every interview we had, every approach that we fielded, we learned. And what we learned is that we needed someone exactly like Doug to take the reins and take over the process.
Thank you, Cynthia. Thank you for sharing. So, Donnie and Todd, excuse me. There's a range of things that can emotionally happen here, right? I mean, whether it's a group of people that own a business or a family business, I mean, you kind of have to balance preserving the legacy while transitioning ownership. And again, I think as Cynthia said, hey, we wanted our son to do it, and grandson, I mean, hey, there's all those range of emotions that you go through. So how do you balance preserving the legacy while transitioning?
And I think this is probably going to lead in some to what Doug's going to talk about here in just a minute, which is things that factor into the valuation of the business. And because continuity is so important, and is going to be such an important aspect of the value of the business, and the fact that a buyer can step in and run the business and maintain continuity. And so I think that also comes back to preserving legacy. That when you have people who are integral parts of the business who can hand off the baton or stay in the business, it helps to preserve the legacy and helps to preserve what makes that business unique. So we helped a company sell, that's probably been 8 or 10 years ago now, and they sold to a multinational company. But the acquirer really liked the management that helped in the valuation of the business. And a couple of the people that are in management of that business are still our clients and are still working managing that company. And so when you think about legacy, from a perspective of someone who steps away from the business, you want it to still, you want to be able to tell people that, yeah, I owned that business, I started that business, and be proud of that. And so maintaining that legacy and maintaining that continuity and being able to be proud of something that you built and still having people that are involved in that, I think is a big key in that. And again, I think that comes into to account with valuation.
Yeah, I think in addition to, you know, you care not only about yourself and your legacy, but part of your legacy are your employees that are going to stick around. And regardless of the situation, your legacy not only, and when you say legacy, what does that mean? Well, my name's Todd Kelly Jr., right? My dad's Todd Kelly Sr. It's my job to, you know, try to live up to that legacy. But the communication, right? Whether it's, you know, with that succession planning, whether you're acquired by, you know, a big corp, multinational, or, you know, it's another family business, just for you to explain right outside of the dollar sign, because a lot of times business owners, when people come from the outside in, you're looking at the books, but it's more than just the dollar sign. You put your heart, soul, dedication into the business, and it's very sentimental. And so to explain that, you know, to the acquirer of the business, I think speaks dividends, because I've seen just the emotions that our clients have shown when it comes to, you know, giving up what I would call their baby. So that's something that I think is very, very important.
Yeah, and so the next question will be to Doug, and obviously, again, if you're emotionally attached to something, it's hey, it's the biggest, it's the best. I mean, hey, it's worth a lot. So, what are the business valuation factors that you know the business owner needs to know and be prepared to present to potential buyers?
Well, that's a great question, Wilson. We could actually probably do a whole seminar just on business valuation, but I'll try to skim it down.
Thanks for volunteering to do that.
Absolutely. But I'll pare it down into two buckets. Okay. So quantity and quality are factors to understand. So let's start with quantity. So this is the earnings of the business. The larger the earnings, the larger the multiple used to determine the sales price. So what does that mean? Okay, profit is greater than revenue. So, and that means top line is important for a business, but it's the bottom line that matters the most. You could have a multi-million-dollar business, top line's really strong, but if you're losing money and not paying yourself, your business isn't worth a whole lot, right? So the bottom line is very important, and you want to make sure that's what you're focused on. And part of that, number two under this bucket, I would say, is clean financials. Cynthia mentioned this. When you're looking at your last 5 years, your tax returns, your current year P&L, balance sheet, that's what a lender and a buyer are going to look at. Okay. And then the third thing is being predictable and consistent. Right now, I've got a client that his cost of goods sold was $1 million 2 years ago. Last year was $250,000. And the revenues are the same. That's a huge swing. That's a major red flag to a lender, to a buyer. That's going to have to be explained. So you want to have a consistent business with trendy lines that are going the same way. All right, so that was the first bucket. The second bucket is quality, and this is how the business is run. So the first thing is the owner is greater than the operator. So buyers want a business that's not dependent on the owner. If an owner goes on vacation, can the business continue to run? And that's not true in all cases. Most buyers are looking for semi-absentee businesses or an absentee business. So when the owner walks out the door, do the clients go with them? If that's the case, no buyer is going to buy your business. So you've got to have people in place to be running your business when you're there or not there. And then also under this bucket, you want to have an efficient business and you want to be above industry standards. So if your business is above industry standards, you can demonstrate how you are a true competitive advantage to your competition. So that's in a nutshell some of the main factors we're going to look at when we value a business.
So to kind of piggyback on that with Doug and Donnie and Todd. So how does a business owner increase the value of their business? I mean, again, we've heard starting 7 years or moving forward. I mean, you're kind of getting to that point where I'm deciding, hey, I'm going to sell my business. Well, I want the value to be as high as possible when I do sell it. So how do I increase the value?
Donnie, you want to start? You want me to?
Well, and I may be out of my league there because Doug and Cynthia, you guys both have experienced this firsthand. But I would just say that what we've experienced and what we've observed from our clients is that one of the major things that starting 7 years out you can do is to make sure that your management, that the people that are in place are, as Doug said, able to take over and manage everything in your absence. I believe that that is one of the easiest ways to increase the value of your business, is just to make it sustainable. There are a lot of things you can do, as Doug said, you know, net earnings, net revenue, increasing that is so important. But to make your business attractive to a buyer and to bring in a buyer who's willing to pay what you want, I think that having that management in place and taking the steps early on to clean up your bookkeeping, clean up the management, and have all of that ready to go. I just can't emphasize that enough.
Yeah, and I'll just say that in terms of the good books and records, so this goes against conventional wisdom a lot of times, is most owners are trying to have a minimal, bottom line so they don't have to pay taxes at the end of the year. But when you get ready to start thinking about selling your business a couple years out, you want to show as much profit as you can, because that's what a bank's going to look at on your tax returns. That's what a buyer's going to look at. Most buyers need a loan to get a deal done. So if the bank won't finance your business for a deal, you're going to be hard time selling it through a loan, which means you're going to have to do seller financing, which means the risk is on you as the seller. And most sellers don't want to do that. So the key term to know and out there for everybody watching is EBITDA. You need to understand what EBITDA is. It stands for earnings before interest, taxes, depreciation, and amortization. So quick example, if your EBITDA is, let's say, $100,000, how we value a business, we're going to look at your business, your industry, we're going to do a multiple of that EBITDA number. Usually it's between a 2 and 4. So if your EBITDA is 100,000, we do a 3 multiple, that's 300,000. Now, if you've got personal expenses, you're running through the business and you can eliminate those to make your EBITDA 150. Now you do a 3 multiple of 150, we're at 450. So by saving 50,000 out of your business, you're going to gain 150,000 in your sales price. Most owners don't understand that. And when they come to us, hey, I want to retire, I'm burnt out, some health issues, I'm done. If they would have done this years in advance, they could easily get much more money for their business if they just followed a few simple steps.
And I'll just quickly add, I think what we've heard from all of the panelists thus far, right, is you have to have a plan. If you don't, in some circumstances, it makes sense. But whether it's Cynthia, Doug, or Donnie, what we've learned from our clients here at Merrill is it's worked out, in the best manner when our clients have came to us and said, hey, Donnie, hey, Todd, I'm ready to sell, or I'm thinking about selling. I think a lot of times when people think of acquisitions, they think it's just a deal that's done. The liquidity is, 100 to 0 all at once. And I would say that's the biggest lie or scam out there. There's so much planning and due diligence that you have to do. And whether it's 3 to 5 or 7 years, I think that sweet spot is 5. But if you can always, increase that, that's just going to benefit you in the long run.
Thanks. Great advice. So Cynthia, you've actually been through this process. So were there specific financial tools or strategies you utilized to help secure your personal finances and ensure the business remained stable when you stepped away?
We had a lot of help. We had a lot of advisors. We did listen to each and every one of them. And I think how you value the business and structure the purchase agreement is very important. That will help you preserve as much of your sales price as you can as far as taxes go. But There's so much that goes into it, and you do need to talk to a lot of people, network. When you make the decision to sell, you need to mentally be ready to put it out there, because you're going to have to talk to a lot of people about it. A lot of business owners don't want to do that. They're afraid. They don't want their clients to know they want to sell. They don't want word on the street that they want to sell. But you really have to get over that, climb that hill, and just get out there and start asking the hard questions, taking the advice, get yourself audited in every way. Ask for goodwill audits, because the SBA is going to do it, and they're going to bring in their independent auditors, and they're going to go through your books and do like Doug said, get your personal vehicles out of there, get your personal insurance out of there, get anything out of there that you can get out of there, and do that 3 to 5 years before, so that you don't see any of that in the books, so that's all cleaned up, all nice and neat.
Donnie or Todd, you got anything to add to that?
Yeah, I would just add two quick things. One is that I would have someone construct a financial plan for you. Whether it's your financial advisor or whomever, have them, everybody has the software with the Monte Carlo analysis and all of that to help you understand how you're going to pay the bills after the business is gone. I would say that's number one. I would say number two is that when you have a plan, stick to the plan. And I would say that the biggest mistake that I see business owners make post selling a business is that most business owners are serial entrepreneurs. And so they've been successful with it before, and they want to continue to be successful as entrepreneurs. And so one mistake I've seen regularly made, I won't use any specific examples of clients, because I think those would probably be easy to uncover, but we've seen people who sell a business and walk away with 8 figures, and within 6 or 7 years, they've gone out and started 3 or 4 other businesses that fail because they're outside of their purview. And they knew what they were doing in the business that they sold, and they were very successful with that. And rather than stick to their cash flow plan and what's going to keep them sustained for the rest of their lives, they go out and make some decisions that are just not very good decisions. So I would just say that if you want to dabble in some of that, that's good. But that's the biggest mistake that I see people post business sell make, is going out and just not being able to leave well enough alone and going into businesses that they don't understand.
Yeah, that's a great way to ruin a hobby too. We've seen it over and over again. You think, oh, well, I really love eating out. Let's do a restaurant. Or, oh, well, I really like wine. Let's do a winery. Or, that's a great way to ruin a hobby.
It is.
Great advice. And I would remind the folks who are logged in to please submit your questions in the Q&A so we can answer them as we get towards the end of the discussion. So, Doug, what goes into the succession agreement, and what legal considerations should business owners keep in mind when developing an exit strategy?
Well, I would say the first thing is have a true business attorney. There are lots of attorneys out there that do different things, such as estate advice, legal advice, but a business attorney is what you're going to want, and also a good financial advisor like Donnie and Todd to help along the way with taxes, because you will get taxed when you sell your business. But things that go inside the agreements, the asset purchase agreement. Number one, earnest money. We always require a buyer to put down earnest money so they have skin in the game. There is what's called a due diligence period that can usually be 15 to 45, 60 days. This is where the buyer can look under the hood of the business, look at tax returns, key financials, key agreements with vendors, clients, employees to verify everything is in order. And they have that ability to do during due diligence. And that's usually after a letter of intent is signed. So when you sign the LOI, it doesn't mean the business is done. It's going to close. The buyer still has the right to come in and examine everything. And a smart buyer and attorney, they're going to have you sign a non-compete agreement, right? They don't want you to go a mile down the road, open up a similar business and take all those clients. So keep in mind, you will have to sign a non-compete agreement. What that looks like, everything's negotiable. There is a transition period from the seller to the buyer. Typically, it's 2 to 4 weeks as part of the sale. Anything beyond that, if the buyer wants you to stay, you can get paid for your service. That can be an hourly rate, can be a salary, can be consultative fee. Everything's negotiable again, but there is a transition period to make sure that buyer has everything, all the tools they need to be successful. And one thing that can get lost is a phone number. Actually lost a deal over a cell phone number because the cell phone number was the only line to the business. And it was a personal number to the owner, also the business number. And when the buyer came in, made his offer, he was going to accept it until he realized he had to give up his personal cell phone number. So know that if that's the main line for your business, you need to change that immediately so that that phone number is inherited to the buyer going forward. Those are kind of the main things I would say that will be in a succession agreement.
Anybody have anything else to add to that they think people should consider?
I will jump in here if I may. During that due diligence period, be prepared for your potential buyer to want to get a new valuation of the company, and be prepared for that valuation to come back and actually not correlate directly to the offer that they made you, to the offer that they have originally signed off on. So be prepared for changes, and that actually can and does happen. Be prepared for that due diligence. It's a very important time, and they do deserve that amount of time because you're asking them to take on your baby.
Thanks, Cynthia. So on average, how long does it take to execute a succession plan in a business, Doug?
So in our world, it's 6 to 12 months. It's not an overnight process. Most times when a lender's involved, they go at their own pace, which is slow. And I'm just kidding. If there's any lenders on the call, actually, they can only go as fast as the documents they receive that they need from the buyer and the seller. But kind of here's what's crazy to think about. When people get pre-qualified to buy a house, 90 to 95% of those people are going to find a house and buy it. But when it comes to buyers for a business, it's less than 10% of those buyers actually find a business that they acquire. And for various reasons, maybe they're not have enough experience, maybe they can't get a loan quite yet, or a loan big enough for the deal. Maybe they're a tire kicker is what we call them, or they're just curious and they think they want to own a business, but they can't quite pull the trigger and follow all the way through. So, Cynthia was saying, it can be 15 to 20 plus buyers you're going to have to meet with and see who's the right one. And that just takes time, right? Because it takes time to get an offer, to get a bank involved. So yeah, on average, it's 6 to 12 months from start to finish is what we see.
Donnie, Todd, you guys see the same thing in your world?
Definitely. And can't stress enough that it starts way before that time period, even that clock starts.
Yeah, I'll just chime in briefly. With our business owners, if you want to sell someday, right, one day, I know I'm not a particular business owner outside of my, our book with the Kose Cross Group, but a lot of business owners that we work with when it comes to the liquidation process, the selling side, they say, I wish I would have started sooner, right? Even for the ones that start, in our minds at a great time. You can always start and to start now, because a plan, if you don't have a plan, you're planning to fail. But just the more, work you can put in on the front end, the easier the process will go when you get to that finish line.
One last
Right.
comment on that.
Go ahead, Cynthia.
We actually formed a couple of relationships with 2 different lending institutions, and we were supplying their SBA loan officers our financials for more than 3 years prior to the sale. So we had one of those lending institutions was they had already seen that their SBA loan officer, had already seen our financials for the last 3 years, had probably 4 or 5 years worth of our financials. Every year I would pump them over. And so they knew how dedicated and serious we were, and they knew our company inside and out by then. And so although that takes a lot of groundwork, that makes the process a little more smooth when it is time, because they're already familiar. They vetted you somewhat on the front end. And so we found that but we didn't stop with just one. We actually were giving our financials to 2 different lending institutions, so that if a potential buyer, which we did not have the buyer at this time, but so that that potential buyer would have an option if they did not have their own financing lined up. If they didn't have someone, then we could say, well, we have a relationship here and we have a relationship here. Meet with these 2 different institutions. They are familiar with our company. They have all of our financials, and then pick which one you might want to work with. And that was actually a strategy that was very helpful, and I think made things work more smoothly for our buyer.
So that brings up a great point and a great question. So what roles do community relationships and networks play in a successful business transition? I mean, I think relationships are key to every business, but I mean, particularly this is a little bit of a different scenario. So what relationships are important, and are they important?
Oh, for us, that's actually how we got our buyer in the end. Was we were willing to talk business to business, and we were willing to actually let other businesses know. And also in our industry, there is an organization that's called the East Tennessee Woodworkers Guild. And so we made it known to the members of the guild, and we would talk business to business. And actually through one of those conversations, the word got to our buyer. He was told by a teacher, someone he was taking a course from, and he happened to already be in our tribe. He was actually already a customer of ours, but when he heard through this third party that we were ready to sell and we were looking for a buyer, he came out the next day. And so that was terrific, because it was that network, and it was that willingness and that getting over the fear of telling people, because people are so afraid. Oh, if people find out we're selling, they may think we're in trouble, or we're going to close, or they may not want to give us an order or do business because they may not trust that we'll be there to serve them. And really, we didn't find that at all. People were relieved to know that we were planning so that we wouldn't have to close the business. And I can speak more to that later if you'd like.
Sure. Doug?
Well, I think that it's important that you handle the process correctly. And so I do believe in hiring professionals in the process. Whatever scenario you take to exit your strategy, have a good business attorney, get a business valuation, and you may be able to get more for it than you think it's worth, or it may not be worth as much as you think it is, but so you know what that is going into the process. And then when you are working with buyers, you're going to give them sensitive information. Make sure they sign an NDA, right? You want to protect yourself, that they're signing a non-disclosure agreement, and then you have every right to ask a buyer for their financials. Hey, how are you going to finance this deal? Show me your personal financial statement. It can be a two-way street. It doesn't have to be just the seller supplying information. The buyer should be doing that as well.
So like in Cynthia's case, I mean, she found somebody kind of in her network as the buyer. Is that usual? Is that unusual? I mean, who are buyers typically? Are they local folks? Are they out of market? I mean, can you describe them?
Yeah, I would say buyers come from all over. There's a lot of local folks looking to buy a business, and typically that can come from a current client, a vendor who maybe wants to move forward and be their own boss and buy a business. You just have to be careful if you have a number of employees, that if they find out, people get nervous during a potential transition. So in most cases, when sellers go to market, it's in a confidential manner. and they're going to list the business with a general description of their business, not very specific. We're not putting a for sale sign in their yard saying this business for sale. That is one of the key differences in real estate. It's got to be a confidential process. So that's why you want them to be signing an NDA. But those buyers come from all over. We've got a list of buyers that are local, that are regional or national, and they're looking for all types of businesses. Just kind of depends on what industry you're in. And that's why it goes back to making sure your business has good books and records and is doing the right process and has good employees in place to make it more attractive to all types of buyers.
If I could
Donnie,
add,
yeah, go
Oh,
ahead, Cynthia.
we couldn't have done it without Doug because we were business operators. We were not business brokers. And so we really needed his expertise. Yes, he was gracious enough to work with us and our particular situation and guide us and lead us through, and his network of professionals was invaluable to us. So just because you may find a potential buyer on your own as a business person does not mean that you do not need a professional's help. You must, because it is a very complex, organism, and it takes on a life of its own, and you never know which way this thing's going to turn.
And I would just say, adding on to that, having a partner like Doug is so important. For one thing, Doug can protect you from your competitors coming in and finding out all your trade secrets. And that's a big one. And the second one is that everybody who owns a business is great at owning business, great at building that business, but has never sold a business. And so having someone who is an expert in that aspect of it is just so critical. And again, understanding that, I mean, Doug's seen people who do things in an underhanded manner just to try and get a competitive advantage on someone who might be selling a business. And he's alert to those things. And so having someone like Doug, I think, is really important to help protect you.
And I'll hop in as well. We've all prefaced this, but confidentiality, it's so important, and there's no way to be vulnerable and be honest unless that's at the forefront. So with us being in the confidential business and Doug as well, working with a professional, you have to be vulnerable. I know it's very, very tough, but you've got to figure out that magic number in order to figure out what that projection of cash flow looks like, post liquidation, in order for Doug to understand exactly what he's dealing with so he can, get you the best deal. So highly encourage business owners to take that step and understand what confidentiality truly means, because I think people, kind of jump in between those lines. Confidentiality is confidentiality, right? Get an NDA. And then two, be as honest and vulnerable as you possibly can in order to take care of your baby, as Cynthia said.
Thanks, everyone. So I'll remind folks you can put questions in the Q&A as we're kind of drawing towards the end here, but I'll give everybody on the panel one last chance to kind of give your closing advice to business owners considering their exit strategies. Let's start with Cynthia, since you've been through this process.
Well, I would like to share that it really is imperative that you begin now. We are now facing health challenges that we had no idea existed when we started this. And actually, I was on the phone with one of the wonderful men that's running my company now, called asking some advice the other day, and I explained to him that if they weren't there and guiding our company and running our company and owning our company and serving our clients, I would have had to lock the doors, and Jeffries Woodworks would be out of business right now because my husband is in cancer treatment presently, and we barely got a year out of the business before this occurred. And this is life. This is what we all do. We all have lives, and we can't expect that it's not going to happen to us. We all see everyone face challenges, and so grab it, do it while you can, make those plans now, and you won't regret it. The sooner you start, you will not regret it. You really won't.
Donnie?
I gotta unmute myself. The one thing that I would say is that from a financial advisor's perspective, if you are planning to sell, involve your financial advisor in that as early as you can, because there are so many tools that we have to help you start harvesting losses in portfolios. Nobody wants to lose money in a portfolio, but there are ways that you can still grow and harvest some losses to offset the gains that you're going to have when you sell your business. The earlier and more runway we have to do that, the better off a person is. And so involve your financial advisor early on so that they can help give you some, because there are strategies that are appropriate for someone who's going to have a liquidity event that if your advisor doesn't know that's on the horizon for you, they can't help you with those things. So just be sure you keep them involved in your thought process and start that as early as possible.
Todd?
Yeah, in collaboration with Donnie, the fact that we have 3 certified financial planners on the team, I think the number one thing that we do with our clients is press the edit button, right? When it comes to plans, we lay the plan out, but I think everybody knows as a business owner, that plan always changes. So not to do it alone, have someone by your side that understands the value of what you want, the goals that you're striving towards. Otherwise, we have no substance to work with, right? There's a reason that you own this business, but post sale, how do we get to that magic number? What does that look like when things happen in your life? How do we change the plan, tweak the plan accordingly to get you to where you want to go? I mentioned the GPS earlier. We're going to get you to the destination, but it might take different turns and detours just depending on your situation. So just make sure you have someone, a professional walking by your side from start. I guess I'd say before you even, sell the business to finish to get you where you want to go.